Hello and welcome back to Insurance World TV, your trusted source for everything insurance made simple, practical, and powerful. Do you have or are you planning to take up life assurance or any long-term assurance product like education policy? If you do, have you ever wondered what happens if you can't keep up with your life insurance premiums? Will you lose everything, or is there a hidden cash value waiting for you? The answer to all these questions lies in a phenomenon called surrender value. In today's video, we break down the surrender value of life insurance policies, what it is, how it works, how to qualify, and the smart options available before you cancel. Don't make a costly mistake. Know your rights, know your value. What happens if I can't continue paying for my life insurance policy? That's a really important question. Yes, life happens, sometimes our income changes, or priorities shift, and continuing with regular premium payments may become difficult. Life insurance policies, especially whole life or endowment plans, are designed with some flexibility in mind, and that's where the concept of surrender value comes in. To fully explain surrender value, we will answer a set of discussion questions. Let's begin. Question 1. What is surrender value? The surrender value is the amount of money you're entitled to receive if you decide to terminate your life insurance policy early, before it matures or before a claim is made. Here's how it works. When you pay premiums on a policy, a portion of those premiums goes toward building up a cash reserve inside the policy. Over time, this cash reserve grows. If you stop paying and choose to exit the policy altogether, you can surrender it to the insurance company and receive the value that's been accumulated, minus any applicable charges. Think of it like walking away from a savings-based policy before its maturity date. You may not get the full amount you hoped for, but you won't walk away empty-handed either, as long as certain conditions are met. Question 2. When does a policy qualify for surrender value? A life insurance policy does not accumulate surrender value immediately. It becomes eligible only after a minimum period of consistent premium payments. Most insurance companies use a 3-year rule. This means you must have paid premiums for at least 3 consecutive years. If you attempt to surrender the policy before this period, you likely will not receive any payout. Example, if you took out a 20-year endowment policy and paid for only 1 year, then stopped, unfortunately you wouldn't be entitled to any surrender value. But if you paid for 3 years or more, you would qualify to receive a portion of your funds back. Each insurance product might vary slightly, so we always check the policy terms. Question 3. How is the surrender value calculated? The actual amount you'll get when you surrender depends on several factors. The insurance company will assess total premiums paid, excluding rider premiums and taxes, number of years the policy has been active, bonuses declared on your policy for participating plans, any outstanding policy loans or dues, type of policy, whole life, endowment, etc. There are 2 main types of surrender value. A. Guaranteed surrender value, GSV. This is the minimum value you're guaranteed to receive once the policy qualifies. It is often calculated as 30 to 50% of the total premiums paid after the first 3 years, depending on the product and year of surrender. Bonuses are usually excluded from this. B. Special or non-guaranteed surrender value. This is often higher than the guaranteed value and includes bonuses or profits added by the insurer. It's not fixed and may vary based on the insurer's performance, market conditions, and product profitability. Important note: the longer you've held the policy, the higher the surrender value tends to be. Question 4. What happens after surrendering a policy? When you surrender a life insurance policy, the following will happen. 1. Your life cover immediately ends. The insurer will no longer pay out a death benefit if something happens to you. 2. You receive the surrender value as a lump sum into your bank account. 3. The policy is considered terminated, and you can no longer access any of its benefits or reinstate it in most cases. It's a clean break. You exchange the policy for cash, and the insurer is released from future obligations. Question 5. Are there alternative options to consider before surrendering? Surrendering should ideally be your last resort, because early surrender often results in low payouts, especially in the first few years. Before surrendering, consider these alternatives. A. Paid-up policy option. You can convert your policy into a paid-up policy. This means no further premiums are required, but your coverage continues with a reduced sum assured. You still retain life cover, and possibly bonuses, just on a smaller scale. B. A policy loan. If your policy has accumulated cash value, you can borrow against it rather than surrendering. It's a way to solve short-term cash flow issues while keeping the policy in force. You repay the loan with interest later, or it's deducted from the benefit when due. C. A grace period and reinstatement. If you've just missed a payment, most policies offer a grace period, usually 30 days. If the policy has lapsed but not yet terminated, some insurers allow reinstatement upon request. This may involve medical checks and payment of missed premiums with interest. And finally, question 6. Other important considerations. Before making a final decision to surrender, it's important to be aware of the following. Surrender penalties or charges may apply depending on your policy. If you've taken a loan on the policy, it will be deducted from your surrender value. In some cases, the surrender value may be subject to tax, especially if it exceeds the premiums paid, and local tax laws treat it as investment income. Once surrendered, the policy is terminated permanently. You cannot go back later and revive it, and you lose all accumulated bonuses or future benefits. Conclusion and summary. So, to summarize. Yes, if you can't continue paying your premiums, you may surrender the policy and receive a surrender value, as long as the policy has met the required minimum active period, usually 3 years. The value you receive depends on how long you've held the policy, how much you've paid, and whether it has earned bonuses. But surrendering isn't the only path. We can explore options that allow you to retain your benefits while easing the payment pressure. That's all for today. We are so glad you accompanied us throughout this video. Please comment, like, and share. If you're new, don't forget to subscribe and hit the notification bell so you never miss a video that could change your financial future.